Managing regular financial obligations efficiently requires a clear understanding of what digital banking platforms permit, particularly when dealing with automated account features. When evaluating financial institutions like Brilliant Bank, depositors frequently look into how routine obligations, automated transfers, and scheduled external movements are handled. Modern online banking infrastructure relies heavily on pre-authorized electronic entries to streamline routine financial tasks, minimize manual overhead, and prevent missed deadlines on mandatory overhead costs. Brilliant Bank structures its deposit and online banking frameworks around specific consumer products, primarily focusing on money market accounts and certificates of deposit rather than traditional checking accounts with extensive day-to-day transaction suites. Because of this structural design, account holders must evaluate how automated instructions interact with the institution's specific electronic funds transfer protocols, savings requirements, and overall transaction limitations. Account agreements explicitly outline how electronic payments and pre-authorized transactions operate within the digital portal. Customers can authorize automated payment structures for eligible accounts under specific operational guidelines. Online banking provisions dictate that bill payments can be arranged on both one-time and recurring basis to designated merchants, ensuring that routine consumer obligations can be managed directly through the digital dashboard. However, looking closer at the mechanics reveals important distinctions regarding how money flows in and out of the institution. External linking procedures often require specific steps depending on the direction of the transfer. For instance, moving funds into Brilliant Bank accounts often requires initiating the transaction from the external financial institution's portal rather than pulling the funds directly through the internal platform interface. Furthermore, outgoing external transfers are subject to specific monthly thresholds, such as a designated maximum limit for external transfers within the online banking environment. Money market accounts provided by the institution come with regulatory and institutional boundaries that naturally affect frequent or repetitive transactional habits. Standard account disclosures limit free withdrawals or outbound transfers to a specific number per month, with nominal fees assessed for any additional transactions exceeding that threshold. These limitations mean that while recurring payments to external merchants or automated bill payment features are supported under the online banking agreements, structuring a high volume of repetitive transactions requires careful monitoring to stay within the permitted monthly free transaction caps. Understanding the timing and processing windows for these automated instructions is equally vital for maintaining a healthy balance. Scheduled electronic payments and pre-authorized debits process through automated clearinghouse networks, which generally operate on business days. If a scheduled transaction date falls on a weekend or a federal holiday, the movement executes on the next official processing day. Account holders must maintain sufficient available balances to cover these scheduled occurrences, as insufficient funds can cause temporary processing suspensions, delayed settlements, or transaction failures. Utilizing these automated features effectively involves aligning internal account settings with the structural rules governing the specific deposit product held. Reviewing the complete online banking agreement and deposit terms directly provides exact clarity on current transaction limits, fee schedules, and authorization parameters. By matching recurring financial needs with the specific capabilities supported by the platform, depositors can successfully automate their routine obligations while avoiding unexpected excess transaction fees or processing delays.